Hello students, today I would like to welcome you all to this video. In this video, we are going to solve topical question, past paper question from the topic Irrecoverable and Provision for Doubtful Debts. So the first question that I am going to solve in front of you is from the October-November 2011 variant 2 question number 2. So let's start. Question says on 31st September 2011, after preparing the sales journal control account, Andrea was advised that Kiara is unable to pay the whole of her debt of $2,500, and Andrea accepted $500 in full settlement, and the balance of the debt was written off. So the requirement is prepare the journal entry to record the transaction. On 30th September 2011, a narrative is not required. So we are going to record a double entry of irrecoverable debts. It says, so irrecoverable is our expense, so we are going to debit the irrecoverable account, irrecoverable debt account. Don't forget, it's the new name of the bad debt account. So you guys can use the bad debt account if the examiner uses the bad debt in the question. So if the examiner uses the irrecoverable word, so I suggest to my students to use irrecoverable debt in your answer as well. So irrecoverable debt account debit, and bank account is also debit because we receive some amount of money. So the amount that we receive is $500, so I'm going to write down 500 in the debit side, and Kiara is not able to pay anymore, so Kiara's account is going to be credited with the full debt. The debt that was owed, so it's 2,500, so the 2,500 will goes on a credit side. So the difference of these two, because we're supposed to receive 2,500 and we only receive $500, so the 200 will become irrecoverable. So write down 2000 will be here. A narrative is not required means we don't need to narrate here, we don't need to write any narration here. So that's the first requirement of this question that relates to our topic. So the moving on to the next requirement, it says Andrea carried out a review of her remaining trade receivables before preparing her financial statement. The following information relating to her debtors was available. The analysis shows that there was a George, Ranjula, Harry and Trupti, and the age of the debt, the relevant amount is written in front of them, and the age of the debt was 1 month old, 2 months old, 4 months old and 8 months old. So Andrea has the following policy for calculating the provision for doubtful debts. The age of debt is up to 3 months, so we'll calculate the percentage of 2%. Up 3 to 6 months we calculate the 10%, and over 6 months we calculate it by the 20%. So what do we need to do? The requirement is to calculate the value of provision for doubtful debts at 30th of September 2011. So we are going to calculate this one by one. So in terms of George, so we have George here, and we have, so we can add both of these or we can write down separately. So we have Ranjula here. So the amount of George is 11,500 and the amount of Ranjula is 9,500, and we have Harry here, and Harry's amount is 5,000, and we have Trupti, the amount of Trupti is 1,500. So the relevant percentages are up to the 3 months is 2%, so it's 1 month, so we'll apply this percentage 2% here because it is less than 3 months. So the 2 months for Anjula means 2% again, and is 3 to 6 months is 10, so 3 to 6 is Harry, so Harry will go with the percentage of 10%, and Trupti is over 6 months, 8 months, so it will go with 20%. Now we are going to calculate this percentage. So let me do this here. So 11,500 into 2%, so 2 divided by 100, so we'll get the number of 230. So write down here 230. Similar to that, 9,500 into 2 divided by 100, so we'll get 190. And for 5,000 we got 10%, so that will give me the amount of 500. And for 1,500 and 20%, I will get the answer of 300. So write down here, and we'll make the total of these numbers to get the total amount of provision for doubtful debts. So it says 230 plus 190 plus 500 and plus 300 will give me the total of 1,220. So this will be the provision figure, the total provision for doubtful debts. Okay, moving on to the next requirement. It says on 1st October 2010, the balance of the provision for doubtful debt account was 1,300, so that's our opening balance, and prepare the provision for doubtful debts account for the year ended 30th September 2011 and bring down the balance on 1st October 2011. So let's make this provision account. Alright, so the opening balance, we know that the opening balance will comes up on the credit side. So we have the opening balance BD 1,300, and always remember that the figure we calculated of the provision is the closing balance of the provision account. So if the opening balance comes on the debit side, we know that the balance CD will come up on a credit side, and that was 1220. So if we know that 12220 is our closing balance, so we can see the difference. So there is a balance decrease in provision, because 1,300 to 1,220 means there is a reduction in the value of 80. So what do we need to do? We need to balance it off. So this side has a bigger value, so 1,300 and 1,300 will come up here. So we'll deduct this 1,220 and we'll get the number of $80, and that will goes to the income statement. It's a decrease in the provision, so it will be recorded in the other income section under the gross profit. So decrease in provision, that's the figure that we need to calculate. So I always tell my student that every time when you write down this balance carried down, don't forget to write the balance brought down here as well with the same number. So that's the provision for doubtful debts account. The next step is the theoretical portion, named the two accounting principle which Andrea is applying by maintaining the provision for doubtful debts. So two principles by which we maintain this provision for doubtful debts is, number one is prudence principle, and the second principle that we apply here is matching principle. So these are two principles that we apply here. So prudence says that do not overstate our assets and profits. So by means of decreasing or increasing the provision, we reduces our profits and as well as reduction in the value of our asset, because we reduce our trade receivables by this number, so prudence is applies by reduction our asset, reducing our assets. So increase and decrease in the provision that goes to the income statement, that's an implementation of matching principle. So let's move on to the next question. So the next question that I'm going to solve in front of you is October-November paper 2022 variant 3 and question number 5. So it's NT started a business on 1st September 2020. All sales are on credit and payments is required from customer within 25 days. On 1st May 2021, so LW, a trade receivable, was declared bankrupt and a debt of 600 was written off as irrecoverable at that date. So prepare the journal entry to write off the amount owed. A narrative is required. So here we need to write the narrative as well. So first of all, what do we need to do? We need to write the date. So date will be the 5th of May 2021. So irrecoverable debt account is going to be debited here. Irrecoverable debt account, because it's over expense, so it's going to be debited with the amount that we will not be able to receive. So 600, and the person name, that is LW is going to be credited by 600. So the narration will be we can write down the narration will be LW is unable to pay $600, so written off his account. So this can be in your own words, so any narration that can explain this transaction, what you have debited and why you have credited. So the narration is done here. So let's move on to the next requirement. It says, in addition to the irrecoverable of LW, there were some other irrecoverable debts of 4,100, so were written off during the year ended 31st of August 2021. The trade receivable at 31st August 2021 were 91,500, and NT decided to create a provision for doubtful debts of 5% of the trade receivables. So now the requirement is we have to prepare an extract from the expenses section of NT income statement for the year ended 31st of August 2021. So that's the income statement section, and we need to prepare the expenses section. So we know that in the expenses we'll write down first of all the irrecoverable, because it's over expenses, so we can have a heading here, so that will be the expenses section. In the expenses section we'll write down irrecoverable debts. So that will be the total amount of irrecoverable debts, 4,100 plus the LW1, so that was 600. So the total of irrecoverable is 4,700, so we'll write down 4,700. So the next is because it's the first year of this trader NT, so there will be no opening provision obviously, so the whole provision of the doubtful debts will be an increase in provision, so that will be the expense. So we'll calculate the provision. It says 91,500 is the trade receivable figure at 31st of August, so the percentage of provision is 5%. We'll calculate the 5%, so that gives us the number of 4,500. 4575. So 4575 is also our expense. So that will be, the increase in provision. So that's the total expense that we will show in relation to the irrecoverable and provision. So 5 7, this will be 2, and this will be 9. Let me double check with the calculator. 4575 plus 4700, it says 9275. So the 9275 is the answer. So the next requirement is prepare and extract from the asset section of NT statement of financial position at 31st of August 2021. Alright, so here we are going to write the extract. So we'll write this in the current asset section. In the current assets, so we know that we'll write down the trade receivables, and the figure of trade receivable was 91,500. It is already adjusted with the irrecoverable debts. If it is not adjusted with the irrecoverable debts, so we will deduct the irrecoverable debts before, and then we will write down this figure, and we will write the less provision for doubtful debts, so this figure will be the closing balance of our provision T account, and that's the amount that we calculated. It was 45, the 5% of this amount, so 91,500 into 5 divided by 100, so that gives me the 4575. So we'll deduct this from this amount to get our answer. So 91,500 minus 4575 will give me the number of 86925. So that will be the net trade receivable figures. So moving on to the next section, it says that during the financial year ended 31st of August 2022, it's mean the next year, the second year, the PB is a trader receivable who owed 7,000, had been declared bankrupt on 17th of July 2022. The NT received a payment of 2,500 by check in final settlement of the debt. The remainder of the debt was written off as irrecoverable. So there were some other irrecoverable debts of 8,400 were written off at 31st of August 2022. The remaining trade receivable at 31st of August 2022 were 110,000. And NT decided to maintain the provision for doubtful debts at 5% of trade receivables. So what do we have to do? We have to prepare the following ledger accounts for the year ended 31st of August and bring down the balance where appropriate. So let's make this PB account first. So it says that the PB is the balance that we're supposed to receive from this is going to be write down as balance brought down, because that was my the receivable 7,000, and we receive only 5,000 by check in the final settlement, so 2,500 check in the final settlement. So we'll record this as a debit bank account and credit PB Limited. So I'll write down the bank here 2,500, and the rest of the amount is declared as bankrupt. So the amount was 7,000 and we receive only 2,500, so 4,500 is declared as irrecoverable. So 4,500 will be irrecoverable debts. So now the date will be, this will be 17th of July, and the opening balance obviously the first date, so that will be the 1st of September 2021. 1, because the year end is 31st of August, so it will start from the 1st of September 2021. So I'll write down this amount. So we'll balance this account. As we can see that both sides has the total of 7,000, so there will be no balance carried down and no balance brought down. This account is going to be closed. So the next account that we need to make is irrecoverable debt account. So it says that we have this irrecoverable 4,500. So that will be from Mr. PB account, and there were some other irrecoverable as mentioned in the question. The other irrecoverable is 8,400. So we'll write down this 8,400. So we don't know the the customer name, so we'll write down trade receivables. So this will be the two accounts of irrecoverable. So we'll make the balance of this account. So it's going to be totaled. So the total of this side is 4,500 plus 8,400 gives me 12,900. So we'll transfer this to the other side, 12,900. There will be nothing to minus, so we'll write down 12,900 because this is an expense account. Irrecoverable is our expense, so the total balance will goes to the income statement. Always remember that the income and expenses account will be transferred to the income statement at the year end. So the year end is on 31st of August, so we'll write down this 31st of August 2022. So the date can be, this one will be done on 17th of July. We don't know the exact date of this, so it says in the question return of 31st of August 2000. So we'll write down 31st of August here. So that will be the T account of irrecoverable account. The next account that we need to make is provision for doubtful debts account. Alright, so as we know, this is the second year of this trader, so we already have an opening balance of provision that we calculated in the previous section. The balance BD will come up here, that was 4,575, and now it says in the question that we have a trade receivable of 110,000. So we need to create the provision of 5%. So in 5 divided by 100. Again, this trade receivable is already adjusted with the irrecoverable debts, so we don't need to deduct them again. So the balance that we need now for provision is 5,500. So this will be our closing balance. So 5,500, because this much amount of money we need in this account. So this will become my balance carried down, and again the balance brought down for the next accounting period. So here we have 4,575 and we have 5,500. So this side has a bigger value, so we'll write down 5,500, 5,500, and now the income statement will come up here. So the income statement will be 4,575. So 4,575 is 925, so 925 will come up here. That will goes to the income statement again. So as we have seen that this is an increase in provision because the opening balance is a lower number than the closing balance. So when there is an increase in provision, it goes to the income statement as an expense. So this is the T account of provision for doubtful debts. The next requirement is the theoretical portion. It says that NT is concerned at the increase in irrecoverable debts. Alright, so the NT is concerned at the increase in irrecoverable debts during the second year of business. To reduce the irrecoverable debts, he is planning to introduce one of the two following options. So the option 1, to charge interest on all debts not paid within his standard terms of payment of 25 days. The second option is to stop supplies to all customers who do not pay within the standard terms of payment of 25 days. So we need to advise and we need to to answer this question, what I suggest to the students to always go with advantages and disadvantages of these options. So if you will go to the option number 1, so there will be the advantage will be the customer will be charged. So the customer will be charged for late payment so that means they will make the payment early, obviously, because to avoid these charge. So they will be charged for the late payment that makes them to make payment early, and for NT to get more amount from late customers, the customers who pay late, so we'll get the more amount from those customers. And the disadvantage we can say for this option number 1 is the customer may switch to other suppliers, because if the other suppliers they allow customers more days, so they may switch to them. So that's the disadvantage. So now if we are check the second advantage, obviously the second option. So if we stop supplying the goods to the customer who will unable to pay within 25 days, so this will also significantly reduces the chance of irrecoverable debt. It's similar to that we are dealing with we are not making any credit sales, so it will reduce the irrecoverable debts chances. And the disadvantage will be and on the other hand, the credit customers is going to be reduced, means reduction in sales value can be done. So these can be the options, or students can write down other options as well. Only the valid points will be acceptable. Now the advice is you guys have to suggest that option 1 or option 2. So if you will say that the option 2 option, I will suggest to go with option 1. So option 1 is suggested or is advised to NT. So that will be the answer. So you guys can write it down in a sentence. So hope you like the video. If you have any comments or any question, please write up in the comment box. Thank you very much.